Hey there, everyone. It's Dan again, just dropping in. It's Monday evening here on the East Coast, and it's early afternoon in the West Coast. And I wanted to bring you in on a nice conversation that I have a wonderful person joining me here today. And this person really kind of is going to turn my world upside down as to how I think about the 401k. She's really known as the 401k queen. She's been in the industry for about 12 years. She's been earning about $300,000 a year, helping people every single day, like you and I. More importantly, she's been married 24 years and has been a business owner since the 90s. And she can even proudly say that she has even now had her son join her in the business. And so I'd like to give a warm welcome to my friend and colleague here, Jessica Zeigler. Jessica, how are you doing? And welcome.
Good. It's great to see you, Dan.
Yeah, so I appreciate you hopping on. I know we're trying to still work out all the kinks here on Ecamm Live, but hopefully this moves along swimmingly for us. And I know I want to be conscientious on time here because we all have things to do, like a screaming baby in the background for me, and I'm sure you've got more clients to attend to on your side. Um, so to kind of like set up this conversation, one, I know you're the 401k queen. A number of people in the industry have taught me that. So I appreciate you making the time. And I was hoping you could really kind of shed some light for me and for the people I'm going to talk with in the future, and for anybody that might actually be watching this live right now. And as background on my end, so I'm a business owner. I've got employees that depend on me for providing a paycheck and a sustainable way of living. And ultimately, I don't want them to just have a sustainable way of living now, but I want to give them a sustainable way of living in the future because I care about my people. That's a crazy thing to say, right? And I also come from a corporate background. I used to be an employee versus a business owner. And I thought I was being brilliant when I was at Procter and Gamble, Berkshire Hathaway, Nike, when I was not just putting in enough for the employer contribution match, but I was maxing out my 401k because I was like, well, I could either spend it at a bar or I could put it towards my retirement. So let's be financially smart and do this. And if you had asked the Dan then for like the 12 years that I did that, um, the three reasons that I would really want to do my 401k were the first one was I would save money on taxes now.
Mhm.
The second one, I would get that company match that I touched on. And then that third one is I assume that my taxes were going to be lower in retirement. Now,
Mhm.
please educate me as to why I might have been thinking incorrectly here, or just play devil's advocate, I guess, and let me know why should I have been thinking a little bit differently, and how can I help others avoid the same mistake that I made for a decade plus.
Absolutely. So the story you're talking about is extremely common on the people that we sit down with and who we help. And a little bit about my background on how I got interested in 401ks and the financial industry in general. As you mentioned, I ran a business from the late 90s and into the 2000s. When the market crashed in 2008, I had to close my business down. And my husband and I were like this close to filing bankruptcy. We were paycheck to paycheck. And so I ended up going and getting a job. I'm like, wow, I'm going like into the corporate world. I'm excited about
Yeah.
this. And one of the things we were offered, I'm like, finally, a 401k. So one of the things that happened was when I ran my own business, one of my clients was an investor and
Mm.
he worked on Wall Street. He was featured in Bloomberg. Like he was somebody who absolutely knew what he was doing. And when the
Yeah.
market crashed, I watched him close down his investment firm. He had been taking a portion of our money that he was paying me
Yeah.
and putting it away into an IRA account, a brokerage account. I couldn't even tell you because I let him take care of it and didn't really know much about it back
Yeah.
then. But he was putting away money for me, and I was in my mid to late 20s, had about $20,000 in there, going like, wow, like this is great. Well, after the market crash, I got a check in the mail for $350. And that was my first experience with the stock market and having an account set up. So
Wow.
after that, I was like, okay, well, I want to avoid these. I'm going to use the 401k,
Yeah.
right? Now, I didn't know anything about it, but my company offered it. Like you said, we started putting in, my husband and I, I'm like, wow, we're really adulting now. So we started putting money away into it. And then employees, because I was a manager, I worked as a manager at a medical clinic. they would come and I'd help them with their onboarding and their paperwork, and they'd start asking me questions about their 401k. Like, should I know this? I went through a bunch of HR certifications and HR classes, and you know what I didn't learn about was 401ks.
Yeah.
But who do we go to for advice on 401ks?
Yeah.
HR and the people who are helping us set it up. So I started really looking into it, and I realized like, oh, my money's in the stock market still.
Yeah.
And I'm like, I just wanted to get out of that. And here it is. I thought a 401k was a retirement plan, a retirement vehicle.
Yeah.
But I found it was just as much at risk as this other plan that I had before. So really started looking into it, realized it wasn't where I wanted to put my own money.
Yeah.
So it was harder to sign up clients for it. My husband and I were looking for help with our own finances, and we were turned away by a lot of financial advisors and financial professionals because we didn't already have money. So I ended up finding a company that I really, really liked. I was referred by a friend of mine who was a client. They ended up taking us through how to avoid bankruptcy, how to actually get out of debt, how to start saving money. We got college plans in place for our kids, retirement plans in place. And so then I ended up interviewing, going through my licensing. So that was our story from 12 years ago. But what I learned and what I've been able to help other people with, I'm going to actually share my screen here so I can go over it, was that 401ks originally were actually not meant to be a retirement plan at all.
Okay.
What happened was back in the late 70s, right? Taxes were really high. Taxes were upwards of 70% when you got into that high income bracket. And so they were created as a way for high income earners to take a portion of their money and put it off into the future where they knew taxes were doing what? They were going to be lower. They were going down, right? So they were doing the right thing, setting money aside. So in 1978, these got mass released to everybody. It was the first time in history that people who had no idea how to invest in the market now had complete access to the market and responsibility to pick their own investments. So they were supposed to be a supplement to personal pensions or pension plans, right? Social Security and personal savings.
Yeah.
So Dan, what's happened with pension plans?
Well, those have pretty much gone away. So
they're almost non-existent for our generation, unless you work for the government, the state, and that has a lot of other things that come along with it. So pension plans, how about Social Security for our generation?
Oh, man. I was just having a conversation today with some people on that. That's probably going away too. For anybody probably 40 and under, that's a guarantee it's gone.
Yeah. So we have a lot of people who are just like, well, it's probably not going to be there for me when I get there. So we're now relying on personal savings, and 401k was supposed to supplement the personal savings. And what companies did was they were able to start getting rid of their pensions and offer another benefit to their employees in the form of a 401k. And now we have an entire generation that almost doesn't know anything else. Like, we think we're supposed to use a 401k. This is the plan we're supposed to be in. And so back after the market crash in 2008, when we had a lot of historians looking in and economists looking into these accounts, they said the 401k, right? 401ks were never designed as the nation's primary retirement. They came to be that as a historical accident.
I can't get over the fact that they actually put the words historical accident. That is just wow. And yet
this is retirement plans. They're calling an accident.
Yeah. Right? Oh my gosh.
So here's another one. So Ted Benna, who is actually one of the fathers of the 401k, he helped to get it into the hands of all these different companies and into public hands. He has said there's too many choices, right? They talk a little bit earlier here where like you could choose not to participate. How many people aren't contributing at all? How many aren't contributing enough? So we have a whole generation of people who are way behind on their retirement planning without even knowing, because there's just no prediction on it. But he said, he goes, if I were starting over from scratch today with what we know, I'd blow up the existing structure and start over.
So, all right. Sorry, I have to pause here. And this was in 2013. So we're now in 2024 as the recording of this interview. And that is a decade later. How has this information not become more broadly dispersed then? Because I mean, guess what? The stock market just went down, 25% in 2022.
Yeah.
So even if people would have learned from the father of the 401k saying, we need to blow this up and start it all over again, and somebody else is calling it a historical accident, and this is on CBNC, this isn't some like
Mhm.
crazy news site. This is, reputable sources. So educate me here. Why has something not been done, or what are the opportunities to blow up the system and make something better? And can there be something better?
So an interesting thing on it, if you actually read what their suggestions are, it's higher penalties for
Yeah,
people to touch their money
yeah,
are some of their solutions.
yeah,
The other solutions, it's just more lack of liquidity. The problem is that middle America are the biggest source of users of these plans,
yeah.
right? And how many middle American families can go 30 or 40 years without having an emergency and needing access to their account, right?
Not a lot.
So it doesn't matter if the penalty is 10%, 20%, or a higher percent. If they need that money, they're going to access it. And that just means more benefit to the IRS.
Yeah,
So the plans that they're actually coming up with, these are Congress people who have a very different viewpoint of life and reality as the working household, right? So most of my clients are working 9 to 5, middle Americans,
yeah,
definitely have the higher income earners and the business owners, but the people that are really being affected negatively the most by these plans are the middle income earners.
mm-hmm.
So I have a huge passion to make sure that they're aware of how it works and make sure that they're utilizing them correctly. And it is the people who are in that like 200 to $300,000 a year
Yeah,
that are maxing them out,
yeah,
are trying to use them, but maybe aren't quite in the income bracket that have all of the money to pay big tax advisors to teach them what to do. So we want to bring that right education to families, right?
yeah,
So
yeah. That'd be
why isn't it
huge.
not changed? There's too much of a benefit for the company in offering it, right? Why hasn't it changed? There's too much benefit to the IRS and taxes and penalties for them to really go in and change it. For them to go back and say, hey, we made a mistake might just not be the thing that they want to do, right?
Yeah.
So let's take a look. I actually want to go through an example here. Is it okay if
Okay.
we go through this?
Yes, please.
So if we put together, we're going to go through an example of somebody actually utilizing this plan, maxing out sort of what you were saying.
Yeah.
If you had continued on this path going forward, what would that look like? So here's an example. There's a great calculator. It's on moneychimp.com. You can go on and put in a 401k calculator and do a
Okay.
prediction on your future and what it'll look like. So you just put in the annual contribution. So at the
Yep.
time, they've actually increased it recently, but let's say you were to max out this account at the time when I put these numbers together, it was 19.5. Now it's 22.5, I
Yeah.
believe
I
it
saw
just
those recent
increased
changes.
to.
Yeah. Yeah.
So 19,500 per year. Let's say somebody was maxing this out, right? Kind of best case
Oh yeah.
scenario. If and companies aren't even doing 6% match, but let's say they were making $200,000 a year of income,
Yeah.
and a company was matching 6%,
Yeah.
which maxes used to be, we saw 100% when I first was in business. Then it
Mm-hmm.
went down to 6%. I'm seeing a lot of 3%,
Yep.
seeing a lot of companies not even matching anymore. So
Correct.
it's really becoming kind of a rough thing to see.
Oh,
But let's say
absolutely.
they were to match 6%. That means the company's match is 12,000 per year. If the employee did this for 35 years, from 35 until age 70, we're
Yep.
seeing a lot of people having to work a lot longer because of inflation,
Mm-hmm.
right? So at age 70, and let's say we got a 6% average return rate. And
Okay.
we have examples and articles and everything showing your average return rate that's illustrated quite often is not the same as an actual return rate.
Okay.
So the actual return rates are a bit lower than 6% in a 401k. But let's say we do get that average 6%. We hit calculate. We have $3.7 million in that 401k by the time this gentleman's 70 years old,
No, that sounds
right?
pretty good.
Mm-hmm.
Yeah.
Yeah, that would sound really good. Now, I've been doing this for 12 years. Do you know how many $3.7 million 401ks I've come across?
Not a lot.
Zero. Now, I've seen assets in 3.7 plus,
Yeah.
right? I've definitely seen assets with that. IRAs, 401ks, I haven't seen any with over $3 million in them, which just says that either people aren't funding them this way. They're not performing this
Yeah.
way, right? So this is like somebody doing the right thing for 35 years, no hiccups, maxing it out the entire time. So let's say somebody does do this, gets through that, click the little calculate button. Here is an article. It's actually in, I think it was from a magazine back in the day called Money, but why your
Okay.
401k may only return 4%.
Mm. That might tie to like that 4% rule I keep reading about too. But yeah, keep going. This is good.
Yeah, between after fees, after penalties, after market losses, all those
Oh,
different things.
okay.
401ks are actually statistically percentage wise some of the highest in fees out of all the investment accounts that you could pick from.
Interesting.
So,
Okay.
and the people who know what they're doing with their accounts, they're like involved in their 401ks and involved in the details. They're going to know how to get into the lower fee accounts. But your average household who's like, hey, I just went into whatever they recommended or whatever I was automatically put into, they're the ones that are getting the highest fees taken out.
Yeah, I know when I was in the 401k, at least I was doing the low expense ratio ones, like a Vanguard and things like that.
Yeah, yeah.
Which, those are low expenses, but then there's also some underlying fees, whether that's via Fidelity or ADP or whoever I might be using as my 401k provider.
Sure. Every time you deposit money in there, there's a fee taken out. Every time you move from one investment to another, there's a fee. There's a monthly fee that the company is going to take. If you get there's a whole booklet that you can get with all the fees listed. Probably it's online now. They used to mail it to you.
Yeah.
That fee list was actually not required to be disclosed until after I was in the industry. So it was 2012, 2013,
Wow.
where they legally had to disclose all of their fees. So
Yeah.
these were in place in the late 70s until 2012
Yeah.
without having to disclose any of their fees. And then they used to come in booklets in the mail and they were thick. People would throw them away and not even look at them. Now you have to go on and download them and read through them to find all your charges and fees. So,
good Lord.
All right, so let's take your example here. So this gentleman here, 3.7 million. Now, Dan, when you go into retirement, are you going to take as much risk as you did while you were still working, or are you going to go into lower risk investment?
Well, yeah, you want to go into low risk. You don't want an 01, 08, or 2022 type situation on your money if you're now relying on that as your income.
Yeah. So when somebody's retired, they're going to go into a lower interest rate. Let's say 2% here.
Yep.
Let's say somebody's going to retire from 70 until they want to make sure it's in place.
Yep.
Right? How does 401k guarantee a lifetime income?
No.
You run out, right?
Yeah.
So here, if you want it to last for a long period of time, this income tax rate, this was based off of California federal and state income. If we click calculate here, let's look down here at the bottom. So the annual payout from this account is going to be $162,000 a year.
Yeah.
This client's now going to pay $57,000 a year in taxes, and their net income is going to be $105,000. So this is somebody who went from making $200,000 a year, probably living off of $200,000 a year, now having to figure out how to live off of a net income of $105,000 per year.
Not to mention in a higher inflationary environment too. If they're making $200,000 now, that's probably $300,000 in future terms.
That's right.
Wow.
Every 30 years, the math of it, every 30 years, it's about double. So really, 200,000 would be the same as 100,000, or 200 would mean you'd have to make 400,000.
Interesting. There's so many things that go through my brain right now. I mean, this honestly explains why, truthfully, you see a lot of maybe old people at Walmart being greeters, because they retire from their job and 15 years later, 10 years later, their 401ks are used up, and now they need to have additional means of income in addition to the Social Security they are actually receiving.
That's right.
Okay, so that's not a situation I want for myself, my family, my employees, anything like that.
Right.
And although, hey, a lot of people would be happy with 105,000, that's still a stark contrast than what they were originally making. So I guess it's all through the eyes of the beholder. If somebody was making $50,000 a year, essentially they'd be getting $20,000 a year is how I'm kind of calculating this out.
Correct. But mathematically, somebody who's making $15,000 a year probably couldn't put $20,000 a year into account to get to this point.
Yep. Oh, 100%. No, that's why I'm just like resetting it of, if it's 200,000, it's 100,000. So really, every single person, no matter what your income level is, just assume you're getting about 50% less of what your current income is today is how I'm trying to arrive at it.
Yeah. Yeah, that sounds about right. And
Hmm.
I always ask people at the end of the day, is it how much money you save, how much money is in the account, or how much of that are you going to get to keep?
Keep.
Right.
Yeah.
So what's your take home? What is going to be yours at the end of the day? So let's look at this example here. So let's really delve into, because most often people are using their 401ks. I met with my CPA, and it's a new CPA because CPAs are hard to find and hard to keep.
Yeah.
But I went with the CPA and she started talking about tax savings and tax benefits and where can we put away money to get our taxes even lower.
Yeah.
And so often people go like, well, I'm going to put max out my 401k because I want to save in taxes today.
I mean, that's
So
what I
let's
did.
take a look, right? So let's take a look at what this would look like. So this is Joe. He's making his $200,000 per year. His tax rate's about 35% in California without the tax benefits of the 401k. And again, we know there's additional like benefits, there's other things. So we're going to keep this just really simple math.
Yeah.
But let's say 200,000 times the 35% tax rate means that he's going to pay about $70,000 in taxes per year.
Yeah.
And again, he'll have other write-offs and things like that, but let's just talk about the money he's putting here. So if we look at his tax rate, he's at about a 24%. California has another 10 to 13% in state taxes. So that's where that 35% comes from.
Okay, got it.
So Joe decides that he's going to use the 401k as a tax shelter, put the maximum contributions into his plan. So that 19,500 we had talked about.
Yeah.
So let's do the math. So here, that 200,000 take away the 19,500. That means now he's being taxed on the $180,000 instead of his full 200,000.
For sure.
So taxes are now the 180,000 times the 35%. So he's now paying $63,000 a year as opposed to $70,000 per year in taxes.
Sure.
So without the taxes, 70,000. With the taxes, or sorry, without 401k, 70,000 per year in taxes. With the 401k, $63,000 per year in taxes.
Yeah.
So he's saving $6,825 per year in taxes.
Okay. Not a lot.
Sounds
I
off.
guess.
No, but it still sounds good. If I told you, hey, you're going to put away money here, you're going to save $6,000 a year in taxes, who's going to say no to that?
Sure, but I mean, if I'm multiplying that over 30 years, that can mean a lot. $7,000. Yeah. Okay, you did it. So,
$238,000 you save, and people say, well, that's even more money inside of my account to grow.
Correct.
I mean, tax now, tax later on a bigger amount or a smaller amount, the taxable amount's still going to be the same, right?
Yep.
So 238,000 that you save over the 35 years. So most people are going to sign up for that, and I appreciate you and I are on the same page. 6,000 a year is like not that much, really.
Yep.
But for some people, it sounds like a lot of money. So annual payout amount. So remember, he saved $6,000 per year. But if we look back at that calculator again, remember how much he paid in taxes during his distribution years.
On each distribution. So he's doing $57,000 on each distribution.
Correct. Annually.
Okay. So he's paying $1.7 million in taxes because he chose a tax deferred vehicle. And I know that's like tax rate as of today. Curious on your insight here. I talked to a lot of people in the industry. They think our tax brackets are actually going to be higher in the future just because of the amount of debt that we have in the United States. Is that what you're seeing as well?
Yeah. We definitely get the people who say, well, I'm not sure, I don't know. But the outlook is, if you look back in the 70s, tax rates were 70%. Prior to that, I remember my grandpa telling me about when taxes were 90% earlier in the, I believe it was like the 40s. So if you're looking at going forward, we're at historically low tax rate. Our national debt just keeps getting bumped up higher and higher and higher. What other option is there, right? At some point.
Agree.
Yeah. So this is if taxes stay at the same tax rate. Because again, if he's pulling $162,000 a year, he's going to be in the same tax rate. He's not in a lower tax bracket because of it.
So basically, I'm seeing a $1.5 million difference then between Okay. I mean, that's even more significant than saving $238,000 in taxes. So, okay. Well, hey, I know we're kind of time crunched here. I want to make sure we cover some other elements there. So, yeah, please.
So another thing that impacts these accounts, as I was talking about early on, is market loss. right? We're not getting a 6% return every single year consistently on this. It's going to be going up as well as down. You look
Yeah.
at the 2000s was called the lost decade, right? We look here, this is the S&P 500. We had a
Yeah.
50% loss during the 2001 market crash, the dot-com bubble burst.
Oof.
Then we saw the housing crisis in
Yeah.
08, 57% loss in the S&P 500. Now we have had a big boom or a big return. What happened in 2020? Drop down.
Yep.
Here's one of the crazy things. People go, oh, well, it rebounded. Do you know how many families, because we got a lot of referrals during that time period. We sat with a lot of families who the market had crashed.
Yeah.
They got laid off. Where do you think they turned when they had an emergency financially?
Well, I guess you.
Yes, but they ended up pulling out money from their 401ks at the bottom of the market because they got laid off. They
Oh
had to pull
man.
that money out. They're pulling out at the bottom of the market. So when the market bounced and rebounded back up again,
Yep.
families who weren't meeting with us, the families who didn't know or sat with us after the fact, had pulled money out at the bottom of the market. So they didn't actually get to participate when the market did come back up again.
Yeah.
Right.
Wow.
No, it was the first
That's a
time in
double
history
doozy.
that it is. So they did have the 10% fee waived as one of the benefits during
Okay.
COVID and all of that. But still, it's the bottom of the market. People lost here, it says 34%. Now they're cashing out and then they're paying all
Yeah.
their taxes on top of that. So it did come back up again. As you mentioned, 2022, which I don't even have on this graph here. But 2022, I sat with a gentleman and we did a review of his account. It was actually last January. And during 2022, he had put his $20,000 in, about 12,000 of the company match,
Yeah.
and his 401k was actually $50,000 less than what it had started the year out with.
Oh man.
So he lost 50,000 plus the $30,000 that he and the company had put in together. So it was an $80,000
Terrific.
loss in 1 year during 2022. So we were able to help him roll over. So there is an option. There's something somebody can do.
Yeah.
Instead of having your money just in the market, we can actually go right into something called index growth.
Okay.
So index is a hybrid. It's a type of a fixed account. So your money doesn't go into the market at all.
Yeah.
But it's going to index your money off of the market. So it follows things like the S&P 500. When the S&P 500 is up, they credit your account with the return. If it's down or on a negative for the year, your credit's going to be 0%. Market goes back up, they're going to credit you with the return. So here's a visual of it. The red line is the S&P 500 during that 2000s to 2016.
Yeah.
And the gold line here is an index growth account.
Okay.
So this one actually even has a 5% cap on it. So these, some of these have no cap, some of them have higher caps than that. But
Yeah.
would you rather be in a plan that's going to go up and down with the market, or one that's going to get a constant return and never the downside?
I've got enough stress in my life. I'd like to have a little bit more consistency, especially if that consistency is also historically, although past doesn't guarantee future performance, it is going to lead me to a better outcome.
Right, right. So I'm going to actually show some examples here. There's actually a plan. It's a great alternative today in today's market.
Yeah.
And not everybody's going to qualify for it. It's not something everyone's going to be a good fit for, but it's good to find out if it's a good option. It's called a life insurance retirement plan.
Okay.
So the way that these work is it actually wraps your money in a protection of insurance. We have insurance on our cars, our cell phone. Shouldn't our money be insured as well?
Yeah. I mean, makes sense.
Yeah. So what it does is that insurance protects our money. The way that it works is when we're putting money in, the first thing that's going to get covered is that cost of insurance. The second thing that gets covered is your money goes into a savings bucket.
Yeah.
That gets protection. So it grows indexed. You never have to worry about market loss. It's also protecting against the IRS from taxes. It's protecting against tax liens. It's protecting against civil suits, lawsuits, litigation, malpractice, short sales on homes. Anytime somebody's going to come after your money, they're not able to touch it here. Right?
Interesting.
Works as an emergency fund. There's no 59.5 rule. So 401k can't touch till you're almost 60 years old. People who do, they're paying a 10% penalty plus their taxes when they take the money out. here, there's no 59.5 rule. So somebody can access their money at any point in time without taxes or penalties.
Huh.
It can create a tax-free retirement. So if it's set up properly, our job is to set it up properly. If our clients fund it correctly, then it'll create a tax-free income during retirement. Works as college funds for kids. I used it for my boys for college. I was like, what if they don't go to college? What if they want to go to a trade school? I want to have flexibility and options. My older son ended up, he's like, why would I go to college if I can just go into business with you guys? And I have great mentorship and everything that I need there. So he's in the finance industry now.
Yeah.
So luckily, we didn't put into a 529 plan for him. So this can be used for something else. As well as
smart. I always hear about that on the 529s as well, but I know this isn't about the 529, but this is good that this is a place for that too.
No, 529 plans are very limited, and then heavy taxes and penalties if you use them for something else. So,
yeah.
And we help people save those as well, but as a comparison, this is a great option. And then it works as a high yield savings. So these have averaged over 9% over the last 30 years.
Wow. Okay.
So and then here's the image. They have an indexed growth. So it's part of the protection. So your minimum amount that you could put in is going to be based off of the cost of insurance.
Yeah.
Where you get tax-free living benefits, tax-free death benefit.
Yep.
Right. You can add long-term care onto these plans. There's a lot of advantages. I had a client who I met with them too late, unfortunately, in life.
Yeah.
But they ended up with a medical incident about 17 years, wiped out all of their savings accounts. Right. They've been on dialysis now for the last 17 years, living Social Security check to Social Security check. Right. So these accounts, if we do have those medical emergencies, we can use it for that. But if we end up living too long, then we've got the tax-free income to come in. Yeah. So the maximum amount that you can put into these plans are going to be based off of the IRS guidelines. So there's actually no limit on how much you can put in. It's going to be based off of the size of the plan. The larger the life insurance, the higher the cost will be, but the more money you can put in. So we have clients doing $100,000 a month into plans like this. They have an extra $100,000 coming in to their business or company. They go, where does that go?
Yep.
Right. You can't put it into a 401k because the max is $20,000 a year. You can't put in you could put it in a brokerage account, but now you're paying taxes on it every single year.
Yep.
Right. So here they can get tax-free growth on it. So it's not really set to any specific limit.
Yep.
It's a self-created structure. So how it's set up, it can be smaller for somebody who's saving $5,000 a month, $1,000 a month. It could be larger for somebody who needs a larger tax-free bucket.
You know what I really like about this, what you just pointed out there, Jessica, and sorry for interrupting you there, but what I like about this is I'm thinking about trying to do this for my employees. And I believe that this is a better thing versus the 401k. But I can also put my money where my mouth is. I can actually create a similar thing, like you were saying, for owners, or I could call it an executive bonus plan, whatever I want to call it. And I would be getting the exact same LERP in this situation, maybe a different dollar amount. But then that way, it's truthfully, we are all moving in the same direction. Like we mean what we say versus, corporations. I've looked at some of their, quarterly filings, and I see what the executives use for their compensation package. It doesn't look like they really use that 401k much. And so I like how this is actually the CEO or the owners are actually utilizing the exact same thing as the employees in this situation.
Yeah. So they can be set up by business owners. What you're talking about is an executive bonus plan, and you could do it for all of your employees. So we do free consultations with our clients.
Yeah.
So a company can bring us in. We don't charge anything, sit with every single one of the employees. Yeah. And if the company says, hey, these executives, they've been with us a long time, they're key people, we want to have them around, we want to offer a benefit. These employees, we still want to have something for them. We still want to have them get somebody to sit down with, but maybe we're not quite ready to contribute something for them yet because maybe they're short term, they're not going to be around. If you do a 401k or a defined benefit plan for a company, you have to offer it to everybody, even if, like, I had a name brand key like pizza delivery company who they had a 401k set up. How many delivery people are there for like a season, just for a little while? They come and go. Well, because they were offering it to everybody, but not everyone was utilizing their 401k, they were too heavily contributed on the high income earners that they fell under the basically disqualified for actually offering it to
Mm,
their employees. So they were not following the rules,
yeah.
ended up having to penalize all their executives so much. They had to take money out of it. They had to pay taxes and penalties on the money they took out because it turned out they overfunded it. It was a mess. So it's so much more simple for us.
Oh, Jessica, you might have cut out there. I don't know if it's me. All right, so we are back now. For anybody that was actually watching live at that time, hey, technology happens sometimes. Winter storms happen sometimes, and that's life. And so we're just recording the back final few minutes with my friend Jessica here, and we were on a roll. But don't worry, we can pick back up on this roll. And so Jessica, we were just wrapping up talking about how, okay, the system is broken. The 401k founder himself said it needs to be blown up. Another very, highly respected individual said it was never intended to be this way and it was a historical accident. And so we touched on the LIRP, or life insurance, or an index universal life insurance policy, being kind of that replacement. And so we were just shifting into it before this cut out, into actually seeing like, who are these companies out there that offered, because we know not everybody offers it, and are they as reputable sources as like a Fidelity or an ADP, the most common 401k providers out there, at least in the US. And so I was hoping you could maybe shed some light on that for us, post all of the cutting out with technology.
Yeah, no worries. So one of the companies that I like to work with that I represent, there's a lot of companies who actually do offer these plans.
Mm-hmm.
It's only going to be with A or A plus rated
Okay.
companies.
Yeah.
One of the examples I give a lot of people, because if we're considering safety, somebody
Yeah.
wants some safety, where do you think a lot of people just put their money for safe purposes?
I mean, safe purposes, probably like bonds if you want
Hmm.
safety.
Or
I know insurance is safety.
yeah, yeah. And it's funny
And
that you say that because insurance companies, what do they do with their money? They're putting them in bonds. They're holding
huh,
like low risk bonds. That's essentially where a majority of their assets are. A lot of people will just put their money in the bank,
yeah.
thinking that's a safe place.
I mean, it's
Banks
FDIC insured up
loan
to
out our
250.
money the minute we put it in there, right?
Yeah.
So legally, insurance companies have to back up 100% of whatever our assets are
Yeah.
that they have guaranteed out to people. So if you have a retirement plan with an insurance company, if you have a life insurance with an insurance company, a
Yeah.
college plan with an insurance company, whatever your guarantees are on that plan, they have to back it up liquid 100% of the time.
Ah.
So Nationwide, who I'm going to use as an example today, just as an example, they have about 6 times in assets what they have guaranteed out to their clients right now.
Sorry, educate me on this real fast. This is like where it talks about reinsurance a lot of the times, where like they can only do something if they already have like insurance behind that, backing their numbers, in addition to having six times more
Correct. So
assets.
but they have their own assets, and then they get reinsurance companies to back that up. There's a really
Yeah.
good book called Money, Wealth, and Life Insurance that talks about
Yeah.
all
Okay.
the regulations of it. There's a lot of great resources on
Sure.
it. But I'm going to pull up here an example of, specifically in this case, Nationwide.
Okay.
Right, Nationwide is on your side,
I know. I love it. I love that Peyton Manning's in it too. It makes it great.
right? So yeah, so they're a very, very strong company. We only work with A or A plus rated companies. And in this example, we're going to take the same example of the gentleman saving 19,500 a year into
Yeah.
his 401k
Okay.
and choosing not to do that. Let's say he went over here. Obviously, there's not going to be the company match.
Yep.
There's things that generally we talk about as a benefit from the company, that if he reallocates his money over here, doesn't have that same benefit. But again, is it how much you have saved at the end of the day or how much do you get to keep?
Yeah.
That
How much I can
matters.
keep is what I want every single day. So yes, if it's a
Yeah,
smaller
what's our
total number but a true number, it's better.
that's right. What's our take home?
Yeah.
So again, these plans are going to follow that index growth. So
Okay.
instead of crossing our fingers and hoping Our money is there when we go to retire. If the market's on an upswing, you're going to get credit with the return. If the market's on a down or a negative, the credit's going to be 0%. There's always going to be that safety net there on these plans. So just to orient on these plans, they are intended to be long-term.
Yeah.
Right. We'll talk a little bit about the short-term benefits of them, but they are a long-term investment. It's not something that you're going to flip and buy a big screen TV by, I guess Christmas just passed, but even by next Christmas. It's something where you're putting your money in there, you're going to let it grow. It's going to be something that's a long-term asset, but more accessible than something like a 401k. Remember, if we have our 401k, we can't touch it till we're 59 and a half. Now there's options to borrow from our accounts there. If somebody borrows from their plan, when they're paying it back, they're getting a 5% interest that they're paying back to themselves, but they're also paying after-tax dollars back into their plan. Mm-hmm. So instead of pre-tax dollars going back in, now you're putting after-tax dollars back in. If somebody borrows from a 401k and then they leave a company or they get laid off, they have to pay it back 100%, which they can't always do. So we're going to talk a little bit about accessibility of this plan versus something like that. So here, the first 3 columns we're going to look at. The first column is the number of years the plan's been in place. Second is the age the client is a year after they start it. This column here that we've got the red block around is their annual contribution, so $19,500 a year. You can do it monthly, you can do it quarterly, you could do a lump sum, however you want to get that in there. It says a total annual contribution. Middle columns we're going to ignore because those are based off of a fixed account that we're generally not going to use. They're going to have somewhere between a 2 to 3% fixed account you could put your money in, but we're going to look at the index growth, which is the far right ones over here.
Okay, got it. And I know legally, educate me on this though, because I know insurance is a highly regulated industry. Okay. And so legally, this cannot project anything higher than what is permitted based on lobbyist groups and everything else, right?
So. Correct. So we do have what are called guaranteed columns in here as well. They're going to be based off of, and every client is going to go through these specifically. I've been in the industry a long time. I'm going to do 100% the right thing for my clients every single time. We're going to go through all the details with somebody before we set it up because I want longevity with my clients. I want to make sure they're in the right place, that they're understanding it. Somebody who understands how the plans work, they're going to be around a long time. Our guarantee, because it's tied to the market, is going to be 0%. What can we guarantee the market's going to do? We can't, right? So that's going to be based off of if the market goes down over the next 20 years, 30 years, what would it look like? These here, their fixed account is going to be based off of the fixed return rate that they have in place. The indexed return rates that they illustrate is actually significantly lower than the historical return rates. The insurance companies are way more regulated than other industries are. And we're not actually allowed to illustrate the rates that it's actually performed historically. So we're very suppressed on our illustrations, which it's not a bad thing. I'd rather under promise and over deliver, right?
I mean, hey, I'm fine with that. I like setting the bar low because again, I know it's not all about the total dollar amount that grows to, it's how much you can actually utilize that dollar amount. So I get that part. You want to talk to me about these first 5 years, how honestly it doesn't perform truthfully from a dollar perspective.
So let's look at it on a short-term basis. So these are illustrated somewhere between a 5 to a 7% because there's a blend of different indexes in here. So it's going to be between a 5 to 7%. And in the first 5 years, like I said, it's not a long-term investment. Year 1, client puts in $19,500. He's going to have $17,000 in his account. After that $19,500 goes in. Remember I said earlier, the first thing we're going to be covering is that cost of insurance. God forbid something happens to this client in year 1, his family gets $767,000 tax-free. Right? So that $17,000 is going to be his $19,000 minus the cost for the plan. Right? So I ask somebody, hey, when we set this up, do you plan on retiring in the next 5 to 10 years? Do you plan on using this money in the next 5 to 10 years? And those are going to be some of the things that we take into consideration if this is the right fit for someone or not. Because if we look at it short term, you put $19,500, you've got $17,000 in there. It looks like not a great option,
Yeah,
right?
correct.
But we're looking at, again, something that's long term and something we're setting up that can utilize. Now, if the net surrender value, this one here, this is what the client has access to borrow from.
Mm,
And if they cancel the plan, what they're going to walk away with. So again, when I'm sitting with my clients, I go, hey, if we put this 19,500 in, we start putting this plan together. Do you plan on canceling this plan? Are you going to walk away with it?
yeah,
Because if they're walking away, it's going to be with quite a loss, or what they have access to is not going to be 100% in those beginning years, which
sure.
is fine. Again, what's more likely, not more likely, but more of a concern during those early years, if they're not planning on retiring in those short term years, if they're not planning on using all of this asset during those short term years,
Mhm.
it really, the bigger risk is if they pass away.
Yeah. Okay.
So if we put, let's say in the first 5 years, we put $97,000 into a 401k or an IRA, what will that grow to? Maybe a 6% return over those few years,
Sure.
maybe a negative return over those 4 years or 5 years. If somebody passes away, their family's going to get whatever comes out of that. They're going to pay the taxes on it.
Yeah.
Right here, again, if somebody passes away or if they get sick, they'll have chronic critical or terminal illness or a long-term care
Yeah.
plan associated to this. So that's, it'll be hundreds of $1,000s that goes to their family, right?
Wow. Yeah. So I guess as I think about this, trying to tie it back to like my corporate experiences where,
Mhm.
in the corporate world, a lot of the times you get a 5-year vesting schedule. And
Okay.
that's what incentivizes you to stick around that company because really, if you leave
Yeah.
before that, the vesting's not worth it. So almost in the
Mhm.
same way, if I liken this to the employer world, well, by having this policy in place, it's kind of like a vesting schedule because it looks
Yeah.
like pretty much at year 5,
Mhm.
it's now pretty much self-funded, at least for the insurance coverage part. If I never wanted to put money into it again, it's then after, like you said, maybe the 10th year that you can no longer just see this as an insurance benefit, but now you're
You're
actually
saying
creating that
correct.
savings vehicle or that infinite banking concept. Am I understanding that properly?
Yes. Yeah. So it is on the shorter term basis, you're really looking at setting it up, getting something that's in place. Now, the cool thing is, let's say in year 4,
Yeah.
year 5 here,
Yeah.
somebody goes, oh my gosh, I need a new car, but interest rates on cars are terrible right now.
Yep.
What do I do? You can actually take a loan. You can take money out of your own personal bank,
Yeah.
right? You can take a loan out of, right, the Bank of Dan,
Yeah.
take that money out and pay yourself back. During
Okay.
the beginning years, it's usually around a 2% net interest rate
Hmm.
that you're going to pay during those first 10 years. They charge a certain amount, they recredit a certain amount. Every company is going to be a little bit different, but it ends up being about a 2% interest rate.
Okay.
The cool thing is, let's use year 5 as an example.
Hmm.
There's $100,000 in the account.
Yep.
You have access to 89. You go, hey, I'm going to take 40,000 out. I'm going to go purchase a car. I'm going to pay myself back.
Yeah.
Well, your full 100,000 is still invested in the indexes.
Okay.
So your full 100,000 is still earning an interest for you, even though you took the 40 grand out to go purchase a car, do a down payment on a home,
Yeah.
whatever it is that you did with it. And you create your payment schedule. How do you want to pay it back? How fast? Oh, you want to take a few years. Oh, you want to do it quickly. So you get to create that. Now, if you don't pay it back, let's say you pass away, it's going to come from the death benefit. So your
Yeah.
loan gets paid out before it pays out to your family. So that's the collateral or the leverage so
Sure.
that the company is able to do that and still invest your full value.
So this is like I get to become my own bank. I get to use my
Correct.
dollar twice here because I understand with like local banks they get to do maybe a 10-to-1 ratio of assets in to debt out there.
Correct.
For me, I'm actually getting to use my dollar twice, which is kind of cool.
Yeah. And if you're really savvy or if you really have some good leverage, you actually, like a buddy of mine ended up buying he was looking for a Rolex. I'm not a big Rolex or name
Yeah,
brand person, but he
sure.
really had been searching for this Rolex for a while, and it could be an investment as well.
Yeah,
Finally found it. He used his Amex to buy the Rolex,
yeah,
pulled money out of his life insurance retirement plan, paid, or his personal bank,
yeah.
paid the Amex off. So now he got his points. Now he got his loan here. Now he's paying his loan back there.
Yeah.
So you're using your money multiple times in that sort of a scenario.
That's too cool. I
Yeah.
mean, I love this. So I guess this is kind of the solution to the 401k system needs to be blown up. But keep on educating me here because this is lovely.
So let's take a look at the net surrender value. Let's say the market crashes. Maybe somebody loves their 401k, they're still utilizing it, but they want to supplement, so they have something else here. Their other investments crash, or their real estate that they can't have access to because the real estate market's not a great time to sell. And they're like,
Yeah.
oh my gosh, this account here is never going to go down. So let's say the market's down in year 8, there's 175,000 here. This money will actually be accessible when other plans aren't. Somebody can borrow from themselves. They don't have to worry about it having gone down.
Yeah.
If you look here at year 11, after a full 10 years in the plan, the net surrender value goes away. So you now have access to 100%.
Wow.
The interest rates on the loans also become a wash loan. So you borrow your money, you pay it back. There's essentially almost no interest rate at that point.
Wow.
So
I
yeah,
get a
you've
0%
got full
loan
access.
on the Bank of Cosgrove.
Correct. You got your own
Okay.
bank going. Now, if we look at this on a longer term, again, we're comparing this to the gentleman we looked at earlier.
Yep.
He keeps putting in. He's just going to be consistent, steady Eddie, contributing to 70 years old down here.
Mm-hmm.
He now has, at 70 years old, 279, almost $2.8 million in his plan. Do you remember what he had in his 401k?
Oh God, what was it? Was
Just
it
a while ago.
3.7?
3.4, I
Yeah,
believe.
3.4. Yeah.
So again, he actually had more money in his 401k at the end, right? And again, it's not how much you accumulate,
But
but
he
how
pays
much of
that
that is
35% tax.
right? Well, the other thing is too that in that account, what did he have to do when he went to retire? He had to move from the more risky,
To
higher interest
2%,
rate
3%
investments to
bonds.
a 2%
Yeah.
low risk. These, they have no risk in the first place. So
Yeah.
you're still going to be able to get 10%, 12%, 8%, 3%, 5%, whatever the index is doing, whatever the performance is.
Yeah.
You actually don't have to worry about the downside. So you're still able to take more risk, which is one of the most powerful things on having this long term.
Mm-hmm.
Now
Wow.
look at his net death benefit though. It's grown to 3.5. So you pass away with 3.4 in a 401k, your family's going to pay taxes and whatever to get that out. So you're going to end up with maybe 50, 60% of it.
Yep.
Here, if you pass away, God forbid, at that like max of your assets before you've started distribution, they get 3.5 million tax free, avoids probate. So anytime this money passes on, it's going to pass on very easily to the beneficiaries. Now we don't want them to pass away. Go ahead.
Yeah. I want to clarify though. So they get 3.5, but they also get the accumulated value, right? It's not one or the other.
So what it is, it started out at about a $750,000 death benefit.
Mm-hmm.
With Index Universal Life plans, when somebody passes away, what they're getting is the accumulated value plus that original 750. So the net amount, the total amount adds both of those together. And that's why it's at 3.5. So it took the 2.8 million that was his, added it to the 750. That's the death benefit that's been leveraged through this whole time period. And so the life insurance total now is 3.5 because they get the full amount of his assets plus that original death benefit, all tax free. Okay. So that includes both of them together. But yeah, that's huge because there are policies that are set up, whole life policies or level death benefit policies, that the death benefit always is the same. So if you borrow from it, it lessens the death benefit. These plans are set up to maximize the distribution, maximize how much you can contribute, but also maximize what's going to go to your beneficiaries later.
This is really interesting. So if I'm looking at this right now, just at the numbers at the bottom, $682,000 is what I've put in. Mm-hmm. And I get $3.6 million out.
Correct. If the client passes away at that time, which we don't want.
Yeah. That's not our goal. Let's do 2.8 instead. That's still 4x higher.
Well, and now see what happens when we start the distributions. So this next column here shows their premium. The contributions now are at 0.
Okay.
So they stop contributing. We're not going to put any more money in. We've decided it's now time to retire.
Okay.
And he's able to take out $224,000 per year of distributions. Do you remember what his
Wow.
distributions were?
Like 109,000, something like that.
It was 108,
Yeah.
180 minus the 50 some thousand he paid in taxes,
Yeah.
net about 130, right?
Yeah.
So here he's pulling out again. The biggest reason is because he can stay in a higher interest rate.
Yeah.
He can still earn the higher interest rates, which means he can take out more money during those years because he didn't go to that lower interest rate. But this again is going to be tax free distribution. So this is
Wow.
$224,000 tax free income. He has Social Security, he has other investments. He can take those out, maximize those, and these are not going to affect his tax rates at all.
So
So he does this.
224,000, and I remember his original salary was 200,000. So in
Mm-hmm.
theory, he's actually living at a higher salary than what he's currently getting. Sure, not
Correct.
adjusted for inflation, but that still
Yeah.
beats the 401k version that
Still
we
beat the
had.
401k. And hopefully
Yeah.
it's not his only investment. This shouldn't be the only thing he's doing. This should be supplementing, just like
Yeah.
the 401k was meant to. If we're doing our job, if we're helping somebody to reach their financial goals, this is going to be a portion of their assets.
Absolutely. Yeah. Wow. Okay, so they're able to take out $224,000 a year,
Mm-hmm.
and that equates to total surrenders that they've taken out, and that's over 35 years was the surrender. So they take out $6.7 million.
Correct. So they put in 682,000, same as the 401k on his personal contribution, ends up taking $6.7 million tax free out. Right. And there's at 100 years old, I'll actually go back here. They've maximized their distribution. So there's very little life insurance left at 100. Let's take a look. Let's say he only lives to be 95.
Yeah.
He put 682,000 in, pulled out $5.6 million. Still $1 million that goes to his family. So instead of him
Wow.
taking out during those final years, his family's going to get it.
Wow. Wow.
Right. We go to earlier years. Maybe he's 85 when he passes away. Right.
Mm-hmm.
He still put in 682,000, 3.3 million he got to take out,
Yeah.
and his family gets $2.4 million. Obviously, the longer he lives, the larger the benefit is that's going to be paid out.
Yeah.
But this is huge.
Yeah, I mean, this is massive. Okay, so life insurance is not really for the dying, it's for the living.
Correct. Yeah. And I actually did an annual review with one of my clients recently. He was like, I just want to see how, like, he's like, I just don't remember. So we went back from 2020 to 2023. No, 20,
Yeah.
we went 2019, 2020, 21. So we went multiple years. He hasn't gotten less than a 7% return since he set up the plan. And this includes 2022 that was rough. He was like, oh, 2022 must have been not that great. We pulled it up, still 7%.
Yeah.
So the return rates on these are actually better than what we are illustrating, but we're going to illustrate more conservative. I'd much rather show somebody that they're outperforming
Yeah.
what we put together in the first place.
Yeah. I mean, I can personally say as a user of my own IUL, 2022 sucked on my 401k. I lost 40%. My IUL, I at least got 0% loss. So,
Yeah.
Yes, do I pay my fees towards the IUL? Yes, but I was still a net zero, and that's all I really care about when you're looking at 40% losses somewhere else.
Well, and a good question to ask yourself on that also is when you're paying, would you rather pay for, because we pay fees in 401ks as well.
Yep.
You want the cost to go to loss, taxes, and fees in your 401k, or would you rather that goes to hundreds of thousands or millions of dollars of tax-free money that would go to your kids?
Correct.
If you were to pass away, right? So the cost is really an issue where there's lack of value, and that value here is to have that life insurance for our family, but also the long-term care that you can tie onto here.
Yeah.
So,
I mean, that's huge. Absolutely huge. I don't know what to say here because I was originally excited of just like a 4x multiple on my 682. Now I'm seeing a 10x multiple.
That's right.
And not to mention, it also, again, gives me that comfort and security because, I mean, hell, we know anxieties are at all-time highs. The markets are only becoming more volatile. And we now understand that the 401k creator has said the system needs to be blown up. And we've had other historical people say it was a historical accident. So, I mean, it just makes sense to try and get into these things. Um, I guess I mean, I appreciate all this information. What are we missing here? Like, is there a question I'm not asking right now that your clients commonly ask you that we should be addressing?
So I'm going to stop my screen share
Yeah.
here for the example. Um, go back. So these are very individualized plans. So
Yeah.
getting together with somebody who actually is familiar with them, who sets them up correctly. That's the biggest thing, is the structure of it needs to be correct. The company will do their part and the client needs to do their part. So
Yeah.
understanding the nuances of it, having an agent who's not just trying to sell you something, but will actually go
Yeah.
through the details with you, make
Yeah.
sure it's structured and set up correctly for you. That's the biggest thing. And then understanding it's not a short-term investment. It's not something that is going to be a great asset just overnight.
Correct.
So being like understanding the long-term benefits of having something like this in place and then meeting with your agent on a regular basis. If you have a plan like it already, some people will go, oh, I've got a whole life plan, or I have a universal life, or I have something that works like that.
Mm-hmm.
Then make sure you're meeting with your agent. I've sat with clients that are like, oh, my agent was trying to get a hold of me and I just was ignoring them. And suddenly I had this problem with it. Like they had stopped putting payments in, it was paying for itself. And, they'll run into problems because they're not working with their agent.
Yeah.
A good agent is not a salesperson.
Yeah.
They're not trying to push you into a product. They're an advisor. They're somebody who working with you to make sure it's an asset that's adding value to your family.
Yeah.
So it's just important to use them correctly.
No, I like that. The notion I've always heard is mission before commission.
That's right.
And yeah, if you're doing the right thing, eventually you're going to have good karma come your way. So I'm with you on that. Don't push people into something if it's not for them. It just seems like we have been pushing people into 401ks when it turns out it's not good for them. It almost seems like it's actually only really good for the government and the employers. I'm not quite sure where it's good for the employee, but
when we get into details on it, and you're so right. People will go over the IUL. They're like, I'm going to do some research. I'm like, how much research did you do on your 401k before you got into it?
Yeah.
And once we get into it and like break it down, most of them didn't have any idea how it worked in the first place. And that's how mistakes are made.
Yeah. I mean, I can tell you right now as a business owner, every single 401k provider has educated me endlessly on, hey, we've got the Secure Tax Credit right now, or the Secure Act. So you can get started on these 401ks and the first 3 years are waived of all the fees for you as an owner. Like really motivating you to just get in there. And as an owner, I'm basically making a financially not smart decision by not offering a 401k because I'm passing all these things up. But at the end of the day, I don't care as much about if I'm maximizing the 401k benefits. I care about my actual people. And so if I'm actually putting my people in something better that will give them a life of abundance and their family a life of abundance in the future, well then hell, I just have to hope that they reward me at the end of the day and want to stick around and work with me for a lot more years. Versus just giving them a cookie cutter 401k thing just because I'm going to save a lot of money as the employer.
Yeah. Well, and also, I mean, there are benefits to setting it up. Again, like you said, there's a reason those benefits are being pushed on business owners. But you can set up an index universal life for your executives. You can have the people that you want. Maybe you've got a newer employee or not quite ready yet, or somebody who's been on again, off again. So you can pick who you want to contribute to. They can add money and that becomes a after-tax contribution for them.
Yep.
The company can add money, right, which becomes still a tax write-off for the company. So there are big advantages for companies offering these plans to their employees.
Oh, 100%. 100%. Yeah, we're just scratching the surface on it, but I know that has to be saved for another day. So, Jessica, I don't know if you have any other things. I mean, the major takeaways I got out of this, if I try to kind of summarize this, is I originally had the summation when, again, when I was in the corporate world as an employee and maxing out my 401ks, like an idiot now, but maxing out my 401ks. I was doing it because I was going to save taxes now. I was going to get that company match. And I was assuming my taxes were going to be low in retirement. We've covered today now across the two videos we've had to splice together due to technology. But we've covered that essentially the way I was looking at it, I was just looking at it through the wrong lens. In that, yes, I would save, with the examples you showed, about $238,000 in taxes by utilizing the 401k. But I'd be paying about $1.7 million in taxes when I start taking those distributions. Versus if I did the IUL, I'd be paying my taxes now on the seed, but not on the harvest. Right. And that to me is a lot more meaningful. So the taxes part, then the company match part of, yeah, great. It's free money coming from the company, but again, it's in a 401k vehicle. I could have a year like 2022, lose 25% on my 401k, actually lost 40%. And so like, that's a disaster. And so no company match can offset a 40% loss. And then taxes being lower.
When you're doing a contribution to your 401k, you're maxing it out. Let's say you're putting whatever you're putting in, it's a tax write-off for you. The company puts money in, which is a tax write-off for them as well.
Yep.
Who's going to pay their taxes later on? Right.
Yeah.
So it's not 100% free money because there's a portion of that money that's still going to be owed to the IRS. Yeah. Government still owns a portion of that.
Yeah, that's I love that saying. There's the IRS. So
the IRS, because it's their money.
So I guess all right, you've changed my perspective on how I look at it, and hopefully this education, when it gets out to other people, they'll have a better understanding, as well as like, yes, we might come off as crazy as talking about an IUL replacing a 401k, but that's just because the majority of people have never really heard of an IUL and have been following what the crowd has done, and what has been historically pounded into our heads now for over 30 years is the 401k is the way to go. So thank you, Jessica, for changing my perspective on that. Hopefully you will be able to change other people's hearts and minds. I guess one final thing, like, how can people get in touch with you if they want to follow up?
So we have, best thing is Calendly. I don't know if we can put a link up here, but I have a Calendly link.
Yeah, let's see if I can do that somewhere. How about this? I'll put it in the link of the video that we'll upload. Because, I actually don't know how I can do that live right now.
No, that's totally fine. But yeah, there's we also have a personal website. So if you look up WFG Zylker, Zylker, then our personal website will come up. You can schedule right through there. My phone line is on there where you can call or text. So any questions that somebody has. And again, it's very personalized. Everybody's situation is different. Everyone's individualized. We work with CPAs. We work really closely with professionals to make sure that every single person has the right plan in place for them. Yeah. So it's a personal recommendations, and we want to get together and know our clients, and we don't charge for any of those services. Yeah. So we can then really, really help make sure that families are taken care of long-term in all different areas.
That's beautiful. I love that. I like the personal touch. We are moving more and more every single day to a society of customization. Sounds like a 401k isn't really customizable. This sounds like it can be. So, Jessica, thank you so much. I appreciate it. Thank you for dealing with the technology issues that we had earlier. You are a godsend. So thank you.
It's great to meet you, Dan.
And we'll have to schedule another one of these.
Sounds good.
All right. Take care.
Have a great day.
All right.
Yeah.